This first voiceover is on equity compensation. So we're covering compensation, and as I said in my introduction to this module, that it typically is a compensation that's going to directors or upper management, the CEO, the CFO, because it is equity-based compensation. It does not have to be the case that it's only to upper management, but I'm just saying that typically this is what you see when you read the proxy statements and you look at the compensation to the upper level of management in a company, in a corporation today. So there's two parts to this module. One will be discussing that compensation, and the other part will be on earnings per share. So we are going to be talking about that equity compensation now. To book this compensation, you need to know the value of the compensation, and then you need to know the period of time in which the compensation is going to be expensed, and that is referred to as an earning period, and it is also referred to as a vesting period. Because after it vests, that is to say that the employee has the right to get this equity compensation, then they can do so. So therefore, you are going to accumulate this value in an account that is an equity paid in capital account, and at the end of the time period, it will be transferred over into stock. Sometimes it's at the option of the recipient. In the case of stock options, if the option is exercised, then we are going to have more common stock out there. In other instances, it is just a natural procedure that at the end of that period of time, that amount which is vested will now be stock, and the holder of the stock will just be one of many holders of outstanding shares of the company. So we need to figure out what is the value of that compensation, and then we need to allocate it to the time periods. Now, the value of the compensation is not going to be so difficult because we have the fair value of the stock to use, or we have the fair value of the option to use. It's only a matter of the time. Be sure you get the right time when you make the valuation. The other thing we have to do, though, is to spread it over the period of time in between the grant date and what we call the vested date. So in this chapter, then, what we're going to be spending our time on now is going to be learning objectives 1, 2, and 3. And then we go on and we talk about earnings per share in a separate voiceover. So we have restricted stock plans, restricted stock units, restricted stock awards, and then we have stock options, and then the third one is an employee stock purchase plan. An employee stock purchase plan is a plan where employees can take some of their pay out of their paycheck, and then the company will buy their company's stock for the employee. And what is saved here is there's no payment of a commission on the purchase of the stock. So the employee saves a bit, and the notion here, as with all of these compensation plans we're talking about here, is to get the employee thinking along the same lines as the company. The motivation for the employee should be to do good things because they want the stock value to go up. And I guess you can see from that why, say, a salaried laborer wouldn't be the ideal candidate for one of these compensation plans, because their influence, an individual's influence on stock price, would not be as great as, say, the CEO or CFO. But that's also another reason why, if you have stock options, you also have a greater tendency to have accounting fraud, because a person who has stock options and is in a position of a CEO or CFO can easily see that if they manipulate earnings, stock price goes up, which means the value of their option also has gone up. And I'm assuming some of you have had finance, and so you understand what I'm talking about when I talk about stock options. But we will talk about that a little bit more in a minute. So restricted stock plans, as I said a moment ago, either are restricted stock awards in which you get shares in your name, or units, which is the right to receive the stock. It doesn't really matter which one of these you have as far as the accounting. The only difference in the accounting is the caption. So one will be called paid in capital restricted stock awards. The other one will be called paid in capital restricted stock units. The value which you record, the time period in which you record it, everything is going to be the same with either one of these plans. So what you're basically going to be doing, by the way, with most of these compensation plans is you are going to be debiting compensation expense, which hits your income statement, and then you are going to be crediting the paid in capital account. So here we have some restricted stock units that are being granted, and it is representing 5 million. The shares are subject to forfeiture if employment is terminated within 4 years. What does this mean? This means that they're going to grant the stock to the employees, the key executives, it says here. The key executives do not get the stock, though, on January 1st, 2016. They have to keep working for the company. And if they're still at the company 4 years, which would be January 1st, 2020, then they will get 5 million shares of stock. So they have to continue working with the company to be able to actually get the stock. So you can see when we record it, and we record it for 2016, when we actually record this transaction, we cannot call it stock because they're not getting stock. So we are going to call it paid in capital restricted stock units. Now, the other issue is the debit. And the debit is going to be to compensation expense because it's an expense that has to do with compensation, and it's a necessary expense, I guess you'd say that, for the company. It's what the company has deemed that they're going to pay the executives. Okay. So we have a debit to compensation expense. How much of the compensation expense should be related to the first year? And since it's going to be over a period of 4 years, you're going to say 1/4. Now the other thing is, what is the value of that compensation? What is the value of the compensation? Well, the way we do this is we value the compensation on the grant date. So if it says they have a current market price of $12 a share, then we are going to value it on that grant date at $12 a share. So the 12 times 5, or the 60, needs to be spread over the next years. Now, on January 1st, when we actually grant it, we do not have a journal entry. Now, technically, I guess it's 1/365 times 1/4 times 60, because you can see there's probably some for that 1 days of expense, right? But we are actually saying in this is that for the year in 2016, for the whole year, you want to record 1/4 of the 60. Now, if you're doing quarterly financials, you would need to use an equal amount for each one of those quarters. So every quarter, up until the date in which they actually vest, you are going to see compensation expense for these key executives. and you're going to spread the 60 million over all those quarters. If you do monthly financials, spread it all over all the months. So up here it says no entry is done on January 1st, 2016. They just want you to understand there's no journal entry associated with this. And as I note over here, you're typically looking at this and you're saying, well, if you're granting something to someone and they have a claim against you, wouldn't you record it as a liability? It seems reasonable. But we are not paying them in cash. We are not paying them in service. How are we paying them? We are paying them with stock. So you don't record it as a liability because you're paying with stock. Okay, so you need to allocate that amount. You probably can't see the very bottom on this slide, but the 16 million needs to be spread over 4 years, and that amounts to 15 million per year. So when you do your journal entries for every one of the years, you need to have compensation expense of 15 million. As I said before, if it's quarterly, it'd be 1/4 of 15. If it's monthly, it's 1/12 of 15, and that would be done every month. So you need to spread the 15 million rather equally throughout each one of those years. Now, when you have done this, you're hitting the income statement each year for 15 million. You are adjusting paid-in capital so that it grows and grows and grows, and at the end, December 31st, 2019, or another corollary, be say January 1st of 2020, the total amount in paid-in capital is going to be that 60. And so the 60 then needs to be transferred into common stock because you are going to give this executive, in this case it's units, you're going to give them the units there, that is going to be the same as giving them the stock. So here's what happens then. You have the 60 that you'd put into that paid-in capital account. You're going to transfer it out, and you record it in the same way as if it had been, say, a sale, except I have to caution you now, because if this was a sale of common stock, you would have seen common stock credited for 5, yes, par times number of shares. Your paid-in capital in excess of par would have been the market price on December 31st, 2019 minus par times the number of shares, right? In this case, since there is a delay of 4 years between the pricing of that value of that equity to the time when it is distributed, this paid-in capital in excess of par account, its market value minus par, yes, but its market value on the grant date minus par, which is 4 years back. So it's a little bit different there, isn't it? Some shortcuts we might have taken, we cannot take now. So 5 million times $12 gets you the 60. That's what the arrows are to. And then the 5 million shares times the dollar par is where you get the 5. And the difference goes to paid-in capital. Again, it's not the current market price minus par, but it was market price on the date of the grant minus par. That's that 55. And we would account for restricted stock awards in the same way as we have done this one. The only difference I have to say is that you're not going to call it a restricted stock unit. You're going to call it a restricted stock award. I apologize because you can't see all of this slide. Gravel Industries granted restricted stock units, 60 million of $1 par. Do we care about the par? No, not yet. What we need to do is we need to say, what is the market value on the grant date? The market value on the grant date was $8. It's going to be 60 million times 8, which is 480 million. Now, the questions are either going to ask you what the compensation cost is, or they're going to ask you about the income statement. In this question, it's effect on earnings, so it's income statement, okay? So the compensation cost you're going to calculate though first, which is $8 times 60 or 480. Now the vesting period, the vesting period here, it says employment subject to forfeiture if employment is terminated within 3 years. And it says, furthermore, it does not have to say this statement, but it says it. After the recipients of the restricted stock units satisfy the vesting requirement, the company will distribute the shares. You can assume that when it says a vesting period is, is 3 years, or if it's terminated within 3 years, you are to assume that you need to have your paid-in capital account for the total amount of $480 million at the end of the 3 years. That's what I'm saying, okay? So therefore, you need to equally increase paid-in capital accounts so that at the end of the 3 years you're at 480. How much do you do each year? You do 160. So the answer to that one is 160. The bottom one, you cannot see that option. The bottom option said 480. 480 million again is not compensation expense. That is compensation cost associated with the grant. Sarkinis Jewelers granted restricted stock units representing $120 million par, subject to forfeiture within 4 years. So you know that the period's going to be 4 years. Market price is 5 on the grant date. Be sure it says on the grant date. Okay, so 5 times 120 gets us what for total compensation cost? I believe it's going to be 600 million. Unfortunately, you cannot see that, but that would be option D. As I said before, be careful in these because it says total compensation cost. It does not say compensation per time period, compensation expense. Compensation expense would be C, but the answer to this one is going to be D, which is 600 million. And it's calculated this way. Stock options are very interesting. I find the whole concept of options in general to be quite interesting. Stock options give a person the right to pay for stock at a market price. And I say in this, at today's market price. One of the examples, and that's the grant day market price. Now, one of the examples in this PowerPoint does not use grant day's market price. That is not done today. It is just not done. There was a problem with stock options in which there was a lot of fraud happening. How come the fraud happened? Well, it was discovered that if you give someone the option to buy at a lower price, then this is good. So let's say the board of directors decides that they are going to grant options or right to purchase, and today's market price is, say, $100. But yesterday's market price was 90. So the board of directors decides to backdate stock options and use the value of yesterday, because then the executives can buy at 90 instead of having to buy at 100. Well, that's just unethical because it's hindsight. They have to be given the option to buy at the price that is today's price or the date at which it's announced. You can't go back and do that and give the executives an extra $10 per share. You cannot do that. So what you do is you say, I'm going to give you options. And as long as you keep on working for the company, these options will have value to you if the stock price goes up. So you don't give them stock, you give them the right to purchase at a certain amount. Going back to an example, if today's value of stock is, say, $15, if the executive does a really good job, we would expect stock price to increase. So if you tell them, I'll let you buy that stock in 4 years at $15. Well, in 4 years, the price might be $25. So they could take the option out there instead of paying $25, which is the market price in 4 years from the date. They're going to only pay the option value. So they get a bonus. They get like a discount on their stock purchase. They don't get to purchase a stock today, but if they continue in their employment, the board of directors is going to say, you are going to have the option to purchase at a discount. And it only has a discount, though, if stock price goes up. These stock options need to be valued on the date of the grant and expensed over the time before the stock will be issued. And there's a time period at which usually these options will expire. If the stock price does not go above the option price, then they are worthless, because the only value they really have to the executive is in that they get a discount on a purchase. They get a sale. Okay, it's a sale. It's like if you went in and bought a car, and instead of paying $30,000 for your car, you only pay $20,000 for the car. You know, it's a bonus, but it's only a bonus if that stock price has gone up. Now, the value of stock options is not the stock price value on that day. So it's not the amount of the stock price on that day, which I just said is the amount of the option, the amount they're going to have to pay, because that is today. There's a time value of money aspect to it. Oh, Lordy, you don't want to think about that, do you? But then there is also the thing that there's an appreciation in value. So the further you go out and you're looking at stock price going up, 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 you can see the spread between stock price and this price of stock on the day that this option was granted is going to spread. So the further out you go, you're going to have a greater value associated with those options. But we are going to value our options on one day. And you guessed it, the day you're going to value those options is going to be on the grant date. There is a very complicated formula which I will not ask you to memorize or do. I will give you the value of the options, the fair value of options in your program, in your problems, sorry. But it is programmed in investment firms and use this, and I call it the BS, and those of you in finance are going to know what that formula is. That formula is an acceptable method under GAAP, but other methods are also acceptable. Typically, companies use the BS formula. Now, like all this equity compensation, you have a debit to compensation expense and you have a credit to paid-in capital. And on the paid-in capital is going to be paid-in capital stock options. That's going to be the caption. An illustration here. They grant options to key executives to acquire $10 million of par shares within the next 8 years, but not before December 31st, 2019. Okay, so they can acquire shares of stock within the next 8 years, but they only can start doing it at December 31st, 2019. So we're going to do the compensation expense in the same way. We have to figure out how many years is in between those time periods. Now, I'm tempted to take 2019 minus 2016 and just do it that way. But when I look at this, I realize you have all of 2016, you have all of 2017, you have all of 2018, and you have all of 2019. And if you've been counting your fingers there, you come up with 4. You come up with 4. So as I've said before, if you see something like December 31st, 2019, what is that really? It's January 1st, 2020. And the difference between January 1st, 2020 and January 1st, 2016 is 4. So be careful on the problems here. Now, the exercise price is the market price of the shares on the date of the grant. Well, that's proper. That's what I was telling you. That's the proper way to do it. So it's $35. $35 is not the value of the option. The value of the option, it says here, estimated by an appropriate option pricing model is $8. 35 is the amount that they get to pay for the shares of stock, not before December 31st, 2019. If they want to buy it, they can buy it after December 31st, 2019, or technically sometime during the day on December 31st, 2019. So the total value is going to be this, $8 on the option. And the number of shares, there's one share per each option. So you come up with easily then a total of 80. This 80 needs to be allocated, as we said, over 4 years, 20 million a time. The journal entry recorded, simple, compensation expense paid in capital. At the end of the 4 years, how much is paid in capital stock options going to be? 80 million. Great, great, great. The complicated part with the options, other than remembering not to use stock price, but option price, is to calculate what happens at the end of the time period when the executive decides to either exercise the option or forfeits it. On January 1st, 2016, Parker & Ryan Insurance Company granted 30,000 stock options. They are exercisable no sooner than December 31st, 2018. Oh, goody. We have another one of those when we should go January 1st, 2019, right? To calculate it. Each is 1 for 1, so an option is going to convert into 1 share of stock. The payment amount that they will be paying is $12 per share if they decide to exercise once it vests. But that's not the relevant value right now. The relevant value in the beginning is to think about the $5. Now they say the market price is as follows. That is not relevant. That is not relevant. What is relevant right now is the $5. They want to know what's compensation expense in 2016. The first step is to say, what is total compensation? The second step is to say, how many periods of time am I going to spread it over? And third, you divide. So let's get to this number then. It's off. You can't see it very well here, but I'll tell you it's going to be option D. It is 5 times 30, or 150,000. That's the total compensation vesting period. It's not going to be 18 minus 16, 2. It's going to be 18 minus 16 plus 1, because you need to round up to January 1st, 2019. That's 3 years. And it's going to be $50,000 per time period, spread it equally. Now, what happens if you forfeit? Well, if the company has some idea about the forfeiture rate, now here is when it forfeits. You have to continue your employment with the company. Okay? Now, if the executive leaves, they don't get to exercise the option unless the option has vested. But if you leave before that vesting date, you don't get anything. You've lost it all. I had that question come up a lot from students. So an executive wants to stay, wants to get these options, needs to think about that seriously before they leave. So what would you do if you were a company? Well, if you're a company, you might create options which vest at different points in time just to get your executive to stay with you. And in fact, that's what is very common. It is very common to do that. And the most common vesting period, by the way, is 10 years. So they use staggered vesting and 10-year periods of time. That's the common thing we see. Now, since you're going to think about these executives staying with you 10 years, you know that's not logical. It is not logical. So you estimate. And just like all the other estimations we have had, you understand that if you make a mistake in an estimation, it's not an error. It's just a bad estimate. So we think 95% of these will be exercised. What do? Well, we need to adjust. We need to not put the whole total amount of compensation cost at 100%. We're going to make compensation cost 95%. And then we are going to allocate compensation expense between the time periods. So here's the problem. They grant a right to acquire 10 million of those shares, and then again, we've got that vesting date, and we calculate it at 8, and we would have said $8 times 10 million or 80 million. But now we think 5% will not ever be earned because those executives are going to leave us. 5% of our people are going to leave that are in this group that's getting these options. Well, if we think that forfeiture rate is 5%, then the original way in which we record the journal entry is going to be 95% of the 80, right? 95% of the 80. So the original way you record it is you record 95% of the 80. And I get that to be 76 million. And, 95% times 80 is 76 million. That 76 million needs to be spread over 4 years. So that is 19 each year. And again, doing quarterlies, doing monthly, you're going to spread it evenly, okay, and gradually cause paid-in capital stock options to rise. You're going to have this 19. Now you do this for 2 years. And so you have 2 years of recording this. 19 and 19 or 38. Then in 2018, so 2016, 2017, you each put 19 in there. Your paid-in capital stock options is up to 38. At this point, you realize, hey, I think another 5% is a better estimate. Maybe something's happened. Maybe your employees have started leaving you. So you go on, and this bottom slide is just what I just stated. That's the journal entry replicated for 2017. I'm going to go on to the next slide and explain what happens in 2018. Well, in 2018, you're going to say, if 90% of my employees will exercise these options, and the value of the options is 80 million, then I guess at the end of the 4 years, I should have 72 million, right, in paid-in capital stock options. Well, how much should I put in there for this year? When you do an accumulated depreciation problem and you change your estimates, you spread the difference over the remaining years, don't you? You say, well, what is my balance now? And you divide it, and then you spread it evenly over the next period of time. Because we are dealing with equity, you cannot do it that way. Instead, what you need to do is you need to say, at the end of 2018, I want my balance in paid-in capital stock options to be 72, which is 80 times 90, right, times 3/4. It needs to be 3/4 of 72, because at the end of the next year, after I do my 2019 journal entry, I want my balance in paid-in capital to be 72. So 3/4 of that. Now you're going to back out what you've already recorded, which is 38. And if you back out the 38, you find that you need to do 16 for this year. So I guess it might be helpful if we just talked about what 3/4 of 72 is, and that's 54. So 54 minus 38 gets you 16, all right? Now, if you are going to go on to the next year, you're going to do whatever you need to do to get the paid-in capital stock options up to what? Right, 72. So this is the way it's handled. Again, you're not spreading the difference equally because in the next year, it's 72 minus 54 or 18. So 2018, it's 16. In 2019, it's cut off here in what you're looking at. I know it's the same journal entry. However, the amount of the journal entry is going to be 18 for that next year. Okay? I think I have a repeat of slides here. Now, let's go on and talk some more about stock option plans. And it says when unexpired options expire is what it says up there. But before we get to that, this problem is saying that these executives are going to use their options. So half of the options are going to be used. And remember that we had a total in there of 80 in our paid-in capital. I'm going to go back to the original assumption, and the assumption was that 100% of the options would be exercised. So you kind of have to disregard those other things we just did where we went through the 90% and the 95%. Let's go back to assuming 100% is going to be exercised. That's our assumption when we book it. Then we are going to put 80 in there. Half of that needs to go away. So I need to have half of that go out. Another way to do it would be, say, 5 million times the $8, okay, which is 40. So I'm going to remove the balance of 40 out of that paid-in capital stock options account by debiting it. And those of you who are astute are going to say that means your paid-in capital stock options has 40 left in it, right, as a credit balance. The other thing I'm going to do here, which I do not do with restricted stock units or restricted stock awards, is I'm going to see an influx of cash coming into the company from the executive. And the executive is going to pay, they're going to pay $35 per share for these 5 million shares. So they're buying the shares of stock, but they are also using their stock options up. They no longer have those stock options. Okay? Now there's still 40 million out there. So half of them have been used. This group of executives, half of them have been used, half of it has been used up. Don't care which executives did it. Maybe some exercised all their options. Maybe some didn't exercise any. Maybe everybody did half. I don't know. It doesn't matter who did what. We only know that half of those stock options are being exercised. Now, common stock will be issued, and common stock will be issued based upon par. It's always issued times par, right? So I have those 5 million, half of the 10 million, 5 million at $1 par. The paid-in capital in excess of par account, I apologize, you cannot see the other credit in this. The paid-in capital excess of par on this journal entry needs to be 210 million. I'm going to go back to what I said earlier. I said earlier that in this paid-in capital and excess par, usually it's market price minus par. What about this one? Is it market price minus par? No, it is not market price minus par. It is only the difference between the cash and the value of the stock options, which were valued way back when they were issued in granted in 2016, and the par value of the stock. That's what it is. So you can't see it, but the bottom paid-in capital and excess par has nothing to do with market price. It is a plug number you put in there, and it is 210 million. You can look at your PowerPoints that are published in Canvas to look at those, but that journal entry, 2 debits and 2 credits. Now this one you get to see all of it. So if half were exercised and they were removed, we had a remaining balance or paid-in capital stock options of 40. What happens if they expire? If they expire, you're going to transfer it to paid-in capital, expiration of stock options. Somebody's going to say, why don't we go back and change our compensation expense for the past? Because that would be hindsight. As long as we, in good faith, recorded the paid-in capital stock options correctly, then, in good faith, I mean, we're not trying to be fraudulent in any way in recording it, then we do not go back and make a change. We do not go back and make a change. This would be the same thing as if we were off in our estimates. So obviously someone's going to say, well, then we should have really put only 50% of that value in there. We should have only put the 40 in there in the beginning and not put the total 80 in there. And I'm going to say, yes, that's marvelous, but we're not soothsayers. We don't know everything. Now in the future, if we offer options, we have this hindsight that tells us 50% are going to expire. Now, the other thing I would say about this is whether it's exercised or not, it also has to do with some things that are beyond the control of the executives, such as the stock market. If the stock market collapses, as what it does from time to time, then the value of stock options just goes away. Because if the stock price, in this case, they have a right to purchase for $35 per share, if the price on the market is $34 a share, no one would use their option. They would just go out and buy it in the marketplace for $34. That option has no value. It does not get used. Now, if it's not used, you don't go back and reverse out your compensation expense and your paid-in capital and all this business. You're going to transfer it over and end it at the end of the time period, because you have to leave it open. You leave it open until it expires. You can't close it up. You can't say the stock price is not going to go up to there. It's not ever going to be there. In bad times, sometimes we rebound very quickly. You just can't do that, okay? So we will wait, and when it expires, then we will transfer it over. It does not have any effect on our equity section of our balance sheet other than changing the caption from stock options to expired stock options or expiration of stock options, as this reads. Now sometimes you have stock options which are graded. I explained that. It's a good thing. You want to keep the employee with you. If you have stock options that are graded, there are several things going on. First, it means here you have 20% of the 10 million vesting December 31st of 2016. They're only issued on January 1st of 2016. So you can see that the compensation expense, which is for 2 million times $3.50 or $7 million, is all going to be expensed. The compensation cost is all going to be expensed for those that vest in 2016. For those that vest in 2017, which would be 3 million shares, that needs to be gotten rid of or totally put into the paid-in capital account by December 31st, 2017, or over 2 years. Lastly, the part that's kind of cut off here, the 50% or the 5 million that's going to vest on December 31st, 2018, it needs to have completely gone through the income statement, completely recorded to paid-in capital by December 31st, 2018, and that looks like 3 years to me. So let's spread it evenly over 3 years. So that's fairly easy to think about this, isn't it? The other thing I want you to look at, though, is that the value of the option in each one of these groups is going to be different. Several things happening here. Time value of money happens. The other thing is we would expect in 2018 the stock price to have appreciated more than would have appreciated in that first year. So in a trajectory of stock prices, you would expect stock price to go up, 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 up. Therefore, the difference between the value of getting to buy it at $25 and getting to buy it at market price, that value is going to be greater because market price goes up for those that vest in 2018. So you're going to see a difference of the fair value per option. These are all priced separately then, and they're all priced separately using the BS model or one that's acceptable for GAAP. So the total value, when you multiply it across, you come up with a total compensation of $49 million. There are different ways that you can handle this. I'm going to give you one here, and I may give you other methods when we go through our problems. But I want you to understand this 7, it is completely associated with 2016, is it not? The 2017 group, which is the 12 million, needs to be spread over these two periods of time, whereas this 30 million needs to be spread over the 3, right? So if you look at compensation expense in each one of these columns and you add down, this is going to be 23. This is going to be 10 and 6 or 16, and 2018 is only going to be 10. So we didn't exactly spread it evenly. We spread it evenly according to each tranche or group of vesting amounts. That's how we are spreading it. Again, I'll give you some more problems on this when we work through those problems. So here's one for us to look at. They have 40,000. It's not 10,000, it's 40,000. So 40 times 20, that would be 8,000, right? And 30% would be 12,000 stock options, and it's all to buy equal amounts of shares of stock. And 50, of course, would be 20. So you're going to multiply across those numbers here, here, and here, and come up with a total compensation expense. But when you do your chart, you're going to know that the first batch, which was the 8, is 8,000. Is going to be only for spread over 1 year. And then the next group is going to be over 2, and the last is over 3. So it kind of mirrors what we just did over there. So I'm going to, hopefully, I can't get it all on the slide, unfortunately, but I would say in 2016, you are going to have all of the 20%, 8,000 times 7, or 56. In 2017, you're going to have half of the 12 times 8, or 96, right? So you're going to have 48. And then in the last one, the total amount would be 20 times 12, or 240. So you're going to have half of that. Let's see, no, a third of that, which is 80. So you have 56, 48, and 80. And so in 2016, you would have 184. Now you're going to say, that is not the number that's circled. The number that's circled is 96. You know why it's 96? Because it says up here, in accordance with International Financial Reporting Standards. Okay? So what I would like for you to do is to go to this slide in your PowerPoints, in your notes, wherever it is, and note that the amount which I would like for you to see for 2016 is 184. For 2017, it should be 48 plus 80, which is 128. In 2018, you're only going to have a third of this last group. So a third of the 240,000 is going to be 80, okay? So there's a total of 392 when you work through this problem on your own as total compensation costs. And the amount in 2017 should not be the 96 if we were doing it according to GAAP. It would be C, I believe, is 128. So I will never, by the way, ask you about IFRS. I put this up here because I wanted to work through another problem where we have trenching. Stock purchase plans are a little bit different because in stock purchase plans, you kind of like options in a sense, except that it's immediate. So you don't have to wait a period of time to get the stock. You have an agreement, and the agreement's been between the employee and the company, and the employee is going to be able to purchase stock, and the company is going to purchase it for them. And they are going to then distribute the certificates to the employees. So they're going to have the stock certificates, or it's going to be recorded at an investment house. But the employees are actually able to buy it by having this payroll deduction at less than full price. So if you get a 5% discount, the GAAP rule is to not even call it compensation expense. Just record it as paid in capital for a reduced amount. It's not going to be market price minus par. It's going to be market price minus par times the number of shares minus the discount, whatever discount they're given. Okay, and the cash that is actually coming out here, even though it's a debit to cash, that cash is actually coming out of the employee's payroll in a payroll deduction. So I kind of shortcutted it a bit to make it a little easier for you. I just want you to understand we're just adjusting paid in capital. We're just concentrating now on equity and saying we adjust paid in capital. If they get more than 5%, the rule is it needs to show up as compensation expense. It's not the amount, which is the 5%, or the amount over the 5% that shows in compensation expense. It is a total amount, which means common stock is par times number of shares. Paid in capital is market price minus par times number of shares. What is compensation expense? Compensation expense is the amount of the discount, the total amount of discount the employee is getting. I think we have covered all the main topics which we needed to cover now. The next area is going to be earnings per share, and I'll be doing that